Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oracle.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
These two.
We have a mountain of evidence here detailing one of the biggest strategic shifts in software right now. What we've compiled really reflects this core idea that Oracle is in the middle of a massive, a very deliberate transformation.
Right. They're moving away from that legacy database, giant perception.
Exactly. They're moving into becoming a high-growth AI and cloud infrastructure company. And this isn't just some slow evolution. It's a radical pivot. And it's backed by, well, just eye-watering amounts of capital.
And what's fascinating is that the numbers prove this pivot is already paying off, and quickly. I mean, fiscal year 2025, that was the transition year. Total revenue hit $57.4 billion. That's a solid 8% year-over-year increase. But if you look closer, the story gets much, much stronger. You have to look at how they exited the year.
That's the key thing.
Yeah.
It's not the yearly average, it's the momentum. Q4 of 25, revenue hit $15.9 billion. That's an 11% year-over-year growth rate.
So it's accelerating.
Clear acceleration. Running 3 points faster in Q4 than the yearly average. That shows the engine is really starting to rev up. They left FY25 with real fundamental momentum.
Okay, so if the momentum is picking up, where is the fuel coming from? It sounds like the old software licensing model is fading and cloud is just taking over completely.
Precisely. Cloud services and license support, that's undeniably the dominant engine now. It clocked in at, $44.0 billion in FY25, growing 12% year over year.
Okay.
But again, that's just the starting point. What's truly remarkable is the forward guidance they're giving. This isn't just stabilization. This is a massive acceleration phase. Management expects total cloud growth, so that's apps and infrastructure combined, to accelerate dramatically, jumping from 24% growth in FY25 to get this, over 40% in FY26.
40%. For a company this size, that's extraordinary. And when we dig into that number, it all seems to hinge on one thing, their infrastructure offering, OCI.
It absolutely does. OCI, Oracle Cloud Infrastructure, that's the true rocket fuel here. OCI revenue grew around 50% in FY25. But based on the demand signals they're seeing, they're projecting OCI to accelerate to over 70% in FY26.
70%. That's genuine hyperscaler growth.
It really is.
Yeah.
Especially given the increasingly large base they're expanding from.
So when the CEO says they expect FY26 revenue growth to be, and I'm quoting, dramatically higher than FY25, that's some extreme confidence. Is that just optimism, or is there a concrete contractual basis for that?
It is entirely contractual. And this is where we hit the most striking piece of data in this entire analysis. We have to look at the contractual underpinning for their future sales. It's a metric called Total Remaining Performance Obligations, or RPO.
Right. The money they're already guaranteed to get.
Exactly. It's money customers have contractually committed to pay for services not yet delivered.
Okay, let's talk about that RPO number, because I saw it and it's massive.
Massive is an understatement. I mean, this metric shows real market commitment. That contracted revenue backlog surged an unbelievable 359%.
Wait, 359%?
To hit $455 billion. To put that in perspective, that number is nearly 8 times their total annual revenue from last year.
$455 billion. How reliable are those contracts? What does that actually signal to investor?
It signals tremendous multi-year visibility. It significantly de-risks their future projections. You see, these are huge multi-year contracts offered with governments or massive enterprises for mission-critical builds.
So it's not just a forecast.
Not at all. It is contractual proof that customers are committing immense sums of money for years to come. That $455 billion backlog, it effectively becomes a collateral that lets them finance this whole AI ambition.
That RPO surge basically makes their whole long-term runway story seem far more credible, doesn't it? So what are those long-term projections now?
Well, management is now explicitly previewing that OCI revenue is expected to climb to $18 billion in FY26 and then nearly double again to $32 billion in FY27.
Doubling in 2 years.
Doubling their core growth engine. And third-party analysis supports this. They're projecting Oracle's annual revenue growth to accelerate to about 28% over the next 5 years, almost all of it driven by cloud. This isn't a legacy company anymore. It's being valued like a major growth stock.
So the demand is clearly real. The contracts are in place. The next logical question has to be why? Why is Oracle winning market share against cloud titans like AWS or Azure? What is their competitive moat?
That's the core analytical challenge, right? Oracle's original wide moat was built on high switching costs for its database. It's mission critical. But their new strategy is it's very differentiated. They aren't trying to beat AWS at its own game. They're serving customers those other guys leave behind.
Okay, let's focus on those differentiators. What are the key elements of this new moat?
I'd point to two highly successful elements. First is their strategic approach to multi-cloud.
Explain that because it sounds counterintuitive. Why help your database run inside a rival's cloud?
Because customers demanded it. And Oracle realized that reducing friction was more profitable than forcing everyone to migrate. So they are enabling their mission-critical Oracle databases to run seamlessly inside Amazon, Google, and Azure.
Which is brilliant.
It is. The customer's happy, and Oracle still secures that high-value database revenue. And the proof is explosive. Multi-cloud database revenue grew an astonishing 115% quarter-over-quarter from Q3 to Q4.
115% QOQ. That confirms the strategy is working right now. What's the second piece?
The second key differentiator is their proprietary offering called Cloud at Customer. This is a masterstroke for appealing to highly regulated, data-sensitive industries.
Okay.
Essentially, it allows Oracle to bring its entire cloud stack, including OCI, and run it inside a customer's own data center, behind their firewall.
So organizations like banks, insurance companies, governments, people who have regulations that stop them from going full public cloud, they can get the best of both worlds.
Exactly. It's a hybrid solution optimized for stickiness and compliance. And we saw this work incredibly well. The Cloud at Customer offering grew 104% year over year.
Wow.
And that's why they're building it out so aggressively. 29 of these centers are live, and they're building 30 more this year alone. It's a deep investment in high-value sectors.
And all of this infrastructure build-out, OCI and Cloud at Customer, it's all being driven by one massive type of demand, AI.
Correct. When you look at the potential market size, especially from companies building things like large language models, LLMs, the figures are just staggering. These models need immense amounts of high-performance computing.
So the demand isn't just general cloud migration anymore. It's specifically for AI training and inference.
It is. And some analysts estimate that these big LLM companies could consume $500 billion worth of OCI capacity over the next 5 years.
$500 billion.
That $500 billion estimate, it puts the whole build-out into stark perspective. The potential demand is just that massive.
But this aggression brings us squarely to the biggest risk you flagged: leverage. Building infrastructure this rapidly at this scale requires astronomical amounts of money. What's the financial risk here?
The risk is the trade-off. To become a true hyperscaler, you need that massive capital expenditure, or CapEx. And this leads to analyst concerns that Oracle could spend so much so quickly that it could result in 3 years of negative free cash flow.
Okay, let's pause on that. Negative free cash flow sounds terrifying.
It means the cash they generate from operations will be less than what they need to spend on building new data centers and buying GPUs. So to cover that gap, they might potentially add nearly $200 billion in new debt on top of their existing load.
$200 billion in new debt and negative FCF for 3 years. That sounds like a startup burning cash, not a mature tech giant. This is a high-stakes gamble.
It is, but you have to understand, this is the hallmark of a necessary hyperscaler-like CapEx cycle. Amazon and Microsoft went through this. The difference here is how Oracle mitigates that risk. They aren't funding this on pure speculation.
And the mitigation comes back to that massive RPO number, doesn't it?
Absolutely. Despite the debt concerns, Oracle still generated strong operating cash flow of $20.8 billion in FY25. That's a 12% jump. So there's a strong safety net. But the crucial piece, the security deposit, if you will, is that $455 billion RPO backlog.
Right.
That provides the contracted cash flows needed to service that higher debt load.
So essentially, they're taking out a huge mortgage, but they already have the signed multi-year tenant contracts in hand, the RPO guaranteeing the income to pay it off.
Precisely. They are trading short-term financial pressure for long-term infrastructure dominance, and they have the contractual visibility to back it up.
And that visibility is what the market has been rewarding. Let's quickly turn to the technicals, because this story is playing out dramatically in the stock price. Oracle's been a major winner this year, up something like 38%.
And we saw that institutional conviction right when the RPO numbers dropped. The stock surged 12% in a single day after that disclosure.
Wow.
That confirms that institutions saw the backlog and immediately underwrote the entire growth narrative. And we still see active momentum, with recent intraday surges showing that buyers are still confirming the trend.
So the technical picture aligns perfectly with the fundamental story. Strong uptrend, supported by clear, contracted growth.
That's right. And the immediate future holds a key date you need to track. The next major event is the earnings announcement, scheduled for December 10th, 2025.
And the expectations are high for that one.
Very high. Consensus expects double-digit growth in both EPS and revenue. This is really the first major test of whether those massive cloud contracts are starting to translate into that expected revenue bump.
Okay, so this brings us to the final summation. What does this transformation mean for you, the listener, looking at this story?
Well, the core thesis is a complete transformation into an AI infrastructure provider. They are leveraging themselves, heavily taking on significant debt and short-term FCF pressure to fund the build-out required to capture AI demand.
But the key differentiator here, the reason this isn't just a blind gamble, is the contractual visibility. That unprecedented $455 billion RPO backlog suggests the long-term payoff is robust enough for institutions to overlook the near-term financial stress.
So keep tracking that OCI growth acceleration, look for management commentary on capital deployment, and definitely mark your calendar for that December 10th earnings release.
Thank you for joining us for this analysis. If you appreciate these daily insights, remember to subscribe to Smart Wealth with Joshua for more.